Welcome, everybody, to another episode of Sound Money Matters Live. This is your host, Daniel Diaz. And without any further ado, I'm going to bring up Rob Kientz. Rob, what's up, buddy? How you doing?
Doing good, man. How you doing?
Good, good. So, guys, what we're going to be talking about today with Rob, first about gold and silver recovering. We're up about almost $300 since, I don't know, late last week, up $157 a day. I think we're up $140 on Friday. And then silver is up probably about $7, $8, about 10%. On silver since Friday, and then probably another 7% on gold. So it's finally happening. What we've been discussing, that the war inflation, people going to the dollar, the stock market going down. We're finally starting to see gold detach from the markets, which is what we've been talking about and what historically has been happening during every single bull market and global financial crises. So before we jump into the global financial crisis 2.0, Rob, tell us a little bit about why the gold and silver is recovering. I touched on it briefly, but go ahead and share with the audience your analysis on what's happening.
I've been following gold and silver for 17 years, and I don't claim to know everything because I don't. But there's a lot of things you can't know because the data is not there. And I'm a data and a study sort of guy. And I get a feel for markets by sort of reading the matrix in a way. And there's stuff that we don't know, but I've come across the last 6 months of seeing what's going on. I've come across new information. I've gotten really good at feeding data into AI to help me out. I've got really good at spelunking the internet. And I found things out about the Comex that I understood, but not at a certain depth. And essentially, I'll just summarize real quick. I've done a couple of videos on this, and I think there's a lot of people pushing back saying this can't be true. And it is. A lot of the reason when you have a big smash like you did on January 30th, a lot of the reason these bullion banks who are short, and they are, according to Office of Comptroller of the Currency and the CFTC COT report, that data is available. A lot of reason when they go short, they don't lose their shirts is there's daily settlement on the Comex. And I knew that, but what I didn't know was as soon as they get close to their margin that they put up for each contract, the CFTC auto shuts them down. And to shut someone down, all you do is take a contract the opposite of what you are. So let's say you're a bullion bank, you have a short. If on that contract, and this is per contract, that day the trade moves against you, and that's eating up a bunch of your margin, the CFTC opens a long on that and the system auto shuts it. So the CME group, the CME group, not the CFTC, that's a regular, but the CME group who runs the exchange does it. And so the CME group has got it down to where it's very difficult to bust on a contract. Now, you can lose money. You could bust as a firm if you had that you owned in your house account. If a big bank owned 20,000 contracts of 5,000 ounce silver, and they lost $1 on silver, we'll say it went from 30 to 29. I'm just using a random example of how this works. They have to pay 5,000 a contract. So the thing about this leverage market is you pay a certain amount of money called maintenance or margin to get into the contract. You don't have to put up all the money. Okay. You put in a certain amount. If that trade moves against you on that day, they'll auto close your contract and you don't bust. Okay. Because the money's already put up. And there's an insurance fund behind that, which all traders pay extra fees that go into an insurance fund. So if there's a gargantuan sort of situation and the circuit breakers don't kick in, and the auto closing of contracts doesn't kick in, whether to the long or the short side, depending on who's losing the bet on that day, the insurance fund will help cover it. So the exchange itself is not going to bust because of what the participants are doing on the exchange. The participants are set to lose and they're settled daily. So, and you can close a contract anytime you want. So let's say you have a short and you open the short at $28 and silver goes against you to 33 and you're out $5 an ounce times 5,000 ounces, man, you're out, what is that, 25 grand? If you get close to your maintenance on that, and that's not the maintenance, but let's say, for example, it was, either they'll auto shut you down when you run out of margin, or you can just simply close it right then and there and just take your losses. So I think that, and over the years, stackers and other people that have been watching this market are wondering, why don't the shorts bust? Why don't they bust? Because the exchange is not set up to hold you to that futures contract for a nanosecond longer than you want to get out of it. You have free reign to get in and out as you want. And so on January 30th, to the long or the short, and anybody can do this, not just the bullion banks, the rules are the same for everybody. And I think I understand this a little bit better than I did before, even though I've been following this for 17 years. Because new information, they're publishing new information, and you get more. And anyway, long story short, January 30th, silver intraday is down 34%. It rises and closes down 31. A lot of those shorts were covered, but a lot of the longs started selling because let's say silver goes from 121 to 120. The longs are out $5,000, 5,000 out silver, $1 move, you're out 5,000 per contract. But it went down so much, it went down 31% in a day, that the longs were either being auto closed by the exchange before they ran out of maintenance or margin, and it closed the position out, or they were bailing and closing it themselves. And what happens is when you have a declining open interest environment, open interest is a total amount of contracts open. You have a long and a short. How many of those do you have? Well, open interest fell between February 7th and January 3rd, 13,400 contracts, somewhere like that. But on Jan 30th, the big smashdown day, they closed 8,100. That is by definition a long liquidation. And when longs start to liquidate, it kicks off these algorithms that the big guys use, whether a financial house or a bullion bank or the big players that are on the system. Think of it like you're trading a stock and you do like a limit on your trade so that, if your stock comes down $2, you can auto sell on the market. Well, you can do the same thing on the futures. And so those algorithm auto sells start tripping, and it is a long evacuation. It's what you call like a long liquidation. And that's what caused the thing to just crash down. And I was wondering why more people didn't bust. It's because they'll auto close you before you run out of maintenance. Now, people lost money, but the exchange is not going to bust. And the individual participants, the only way you can bust is if you put in so many contracts that you use up all your free money. You could still trade on the Comex. You're just out of money as a firm, right? So that's why you didn't have widespread collapses in the exchange. That's why you didn't have widespread collapses of bullion banks or other shorts. I mean, producers a lot of times will go short because they're putting out contracts because they're going to sell the silver or gold in 3 or 4 months, or oil or whatever it may be. So they'll go short to protect their price. So the price falls, they make money on the contract to offset the loss of money when they finally go to market with their product. So producers probably lost quite actually gained money because of the short. But merchants who are long, typically long because you're buying the material. So you take a long to ensure against price moves up. Price moves up, you make money on the contract, but you're going to lose money buying a more expensive input into like your iPhone. Okay. So that's how the whole thing works. So essentially what happened was the market just cleared that, the smash down came, but because open interest fell, we basically just reset the board. And so now the board's reset. And to answer your question, we're now starting to get long interest coming back in. It took a massive liquidation. And the reason it took a massive liquidation is, yes, there were a lot of people short. And yes, you can say that can suppress the market, especially if you're spoofing. But in this particular case, the trade had just gotten so high that there were no more longs to push those contracts back long. And once the selling started, everybody had to get out because either they were voluntarily going to do it or the exchange was going to cut them on the way down when they ran out of margin, because exchange is not going to go bust. They're going to close you. They're going to auto close you out in a nanosecond on that trade. So that's essentially what happened. But the interest coming back in is basically people saying, okay, we cleared 1,000 off of gold. We cleared, 43, 44% off of silver. We can go back in long again. And the whole thing just restarts. And this is what drives people nuts who are stacking the physical or who are dealing the physical. If you're a merchant buying the physical, if you're a producer making it, if you deal with the physical, 99.5% of all trades on the Comex are paper only with no delivery component. And people do not understand the way derivatives work. And so I've done a couple of videos really deep diving into the weeds with specific examples. I broke January 30th down in silver, detail by detail with all the numbers, triple checked. And so those videos are real informative, explaining to people how these markets really work. And there are a lot of commentators that are considered experts in the space that do not understand this. And it's taken me a long time to understand. It's a very difficult market to really get information on and understand. But essentially what's happening is it was a futures clearing, but now the momentum's coming back. And one last thing I want to say to ease people's minds, because people are going to be like, oh, Rob, stop telling us the bad news. I'm a stacker. When are we going to have monetary freedom? When is silver going to go to 200 and gold to 10,000, all that kind of stuff, you know? It'll eventually get there. There are 6 times in history I found that silver dropped 40%. Most of those times were in the middle of a massive bull market, including 68 to 80, including 2006 to 2011. The only time where it fell and it didn't recover right away was 2011 because the government fixed the problem by papering it over. And so for 5 years until 2016, nobody was interested in metals. But then, even then, it went from 2016 to now, both of them have absolutely skyrocketed. Silver got down to $11 and something, officially 12 on the chart. But I remember spot being like $11.75. And dealers were like, what the hell? Like I was buying from 50 and it's $11.75, right? So,
and a big part of that too.
Yeah.
A big part of that too dropped interest rates to 0. So people were borrowing at a 0% interest rate or like 1% interest rate to invest into, you know, their companies and the real estate or whatever. And they're liquidating their metals to get cheap debt to, you know, we believe it's malinvestments, right? When you have an incentive to borrow, you need to make a yield to pay that off. That causes malinvestment. So people weren't into metals. I mean, there's a bunch of, it's complicated, right? And the bankers don't make it easy to understand the system either. I mean, it's purposely created to be difficult for the layman to understand what's happening. And even those of us like you, me, everybody else in the markets who are studying, you know, what the CME group and the LBMA and that are doing, it's not easy. They do it on purpose. They use verbiage to confuse people.
It's super complicated. And to finish that part of the story, and then I'll address that comment too, because I have a comment on that. I think it's a very astute comment. Every single time we had a mid-cycle correction, the boom to the upside was more powerful. So even though we've lost 1,000 off of gold and 40-some% off of silver, at the end, when this is all settled and we get through the financial crisis and all that, you're going to see a new plateau for gold and silver price. I believe if looking at the previous situations and charts and things hold true and accurate. And I don't see any reason why they wouldn't, because traders are traders of habit around the world. And that, you know, people are going to flood money back into that trade. Now, going to why is it a futures market and not a physically settled one? If you try to do a physical settled market, China has one. China has 2. They have the SHFE, which is their version of Comex, which is similar rules, not exactly the same. And then the SGE, which is the physical one, because they have Hong Kong with the jewelry. They have all of this gold and silver trade in their ceremonies and in their culture. So they have a physically traded market. That market in China has been running off because people have been buying gold. Even despite the price fall, they've been buying more. Well, in China, you kind of get more honest price. It's still not perfect, but there's at least a heavier physical element. You can get more honest prices. The problem with that is everything is tracked and it's not comprehensive. It can't track at all. And China can only track what goes through the SGE. It can't track around the world. And the problem with physical precious metals, because they're physical, and you can buy them in little 1 gram increments. You don't have to store a barrel of oil, for example. You can get a little baby piece. There's no way for anybody in the market or the government to know that I went down to my local coin dealer and bought $2,000 worth of gold and what I paid in spot and premium. So in the United States, I don't believe we'll ever have a completely physical settled market, that the futures or some other mechanism is going to have to be some sort of component. But I do think that looking at what has happened, not only in the past, but in the last couple of years with the rise, the fall, the violence of it, that we need to go back and look at how this market works. And something you and I were talking about the other day was we need more physical in the economy, so that having more physical in the economy gives us that physical component like China does. And anyway, big, long explanation, but that's essentially what happened to gold and silver. That's essentially how it works. If people are patient and they stack over time and stop trading the metals, history says if it repeats, it's going to be very beneficial for people. And that's the key. You don't got to be an egghead like me and try to go understand it. You can. I wish people would, but just know that history is pretty clear here, that when we go into financial troubles, gold and silver do well. We have mid-cycle corrections of 40% 6 times just in the last 50 years. It's not that abnormal. And so I don't want people to be discouraged about it.
Yeah, I mean, this is the time to grow your stack. I think this is we saw the bottom, got down to, the mid 60s. And I think that's the bottom before we rip up. I mean, we're already sorry. The market's open. We're a little up right now. We'll give it a little bit more time, but yeah, this is the time, guys. Like I told people, dollar cost average in, dollar cost average out. When you liquidate and need to spend, but if you're saving, dollar cost averaging, stacking, setting up. Same message I've been saying for years now. You want to buy as certain increments the same amount and dollar cost in. Because those of you that sold everything see gold and silver as an I almost a daily. I got people coming in. It's like, oh yeah, I'm buying gold. It's an investment. I'm like, let me challenge your thought process on that. Gold and silver is not an investment. Gold and silver is money. It's what you save in. You don't want to save in the dollar. You want to save in gold and silver. So that makes like 100% sense the way that you described it. I mean, it's what we've been seeing. It's what it's been happening. Education is what opens up the mind to understand and see the truth of what's going on behind the scenes. And like I said, I think you were going to comment on that. They purposely make it difficult. They use verbiage like quantitative easing. We didn't know what quantitative easing was at first when they used it back in 08. Now we know it's just money printing and typing in dollars. The way that they use contracts, it's purposely created to confuse the layman, so they don't know what's going on behind closed doors or what's happening in public, but you just can't interpret the data properly.
Yeah, it's just one of those markets you just got to hold on. One of the things I want to point out, between 68 and 80, when silver went from like $1 to $50, it dropped 40% twice, 68 to 71 and 74 to 76. And it went up almost 50 times. So the key here is don't let these mid-cycle type of corrections or washouts or busts or whatever you can call them, don't let them sway you from the long-term value of gold and silver in that portfolio. And I just want to encourage people, if one more thing I'm going to throw in the Fed here. The Fed now, if you look at their chart where the analysts have a chart based on what the Fed says and based on the Fed's dot plot and things like that about when the Fed may ease or raise rates. They're now thinking that the Fed cannot cut this year, and that there's a big chance that it'll be between March and December of next year, an 80% chance. It's gone 80-20 the wrong way if you're wanting easy money, because inflation is persistent, unemployment is worse, and the Fed has recognized the BLS constantly reclassifying employment and losing almost 1 million jobs the last 2 years. Last year of the Biden administration, first year of the Trump. And that job creation is not as strong. And so the Fed is between a rock and a hard place, and they're really in a tough spot. If interest rates continue rising and inflation continues rising, they're going to have to tighten. If they tighten, that could set off a debt tsunami. But if they ease too quick, it could cause runaway inflation and interest rates. And the Iran stuff in the Strait of Hormuz is just wrecking the Fed's plan, because there are 3 main things. 20% of oil goes through there, 30% of fertilizer, and a big old chunk of helium. Helium is used in chip fabrication. Hello, Taiwan. Hello, chip shortage. There's an LNG. Iran bombed. There's 4 of them. Let me do them in order. Helium, chip manufacturing, a lot of other things. Big problem for tech. Big inflation coming in all sorts of tech. Okay, until they get that resolved. Liquid natural gas. A huge amount of that was hit in a Qatar field that supplies that area, that region's 15% of their liquefied natural gas in that region, and a big chunk are worldwide. And Qatar saying 5 years to fix it. 5 years to get back to where they were before the war started. You've got 20% of oil. Oil prices are spiking. That's going to cause inflation across the board because oil is used everywhere, like silver. And then you have the fertilizer issue. 30% of fertilizer, 50% of urea as a component of. And so where are you going to get the fertilizer for crops? So we have food inflation coming. Again, all of these, and I hate that all that's happening, But just from an analytical standpoint, that's going to drive the value of gold and silver up. And that's why you're starting to see a rebound. You saw the sell-off, like Daniel pointed out, and he's 100% correct. All markets, especially derivative markets, which determines gold and silver spot price, unfortunately, sell off at the beginning of a crisis, and now we're starting to get that rebound. But remember what I said, gold and silver have had worse days in weeks and months than they had this year, and they have recovered and done quite well. And that's the encouraging thing.
Yeah, and we got a question from OC Stacker in the line of thought that you were just talking about. OC Stacker asks, if they raise rates, won't that hurt precious metals prices? Typically, when you raise interest rates, it means that the bond yields are higher, and that does have a negative effect, but it also has a negative effect on the stock market. When they raise rates, the stock market doesn't like that. But we are in very high inflation markets right now. We have the war inflation. We have the printing press going like crazy in all the countries because they're funding this war. So even though they're going to raise interest rates, they're raising rates because inflation is too high. So yeah, there might be a small bump, but when you look at the overall market, the bull market in precious metals, we're probably in year 2, almost year 3 of a 10-year bull market. We see typically gold and silver enter 10-year bull markets, give or take a few years, and we're at the beginning of it. And I mean, if you look at some of the top analysts out there, they're predicting. Look at the North Bad charts. Patrick Kareem, we have him on regularly. They're expecting around a $10,000 gold ounce. That's due to inflation. That's due to the dollar losing value. With war, with oil, I mean, this is like the perfect storm to catapult gold and silver. They're in this mid bull market pullback to extremely new highs. I mean, I'm seeing recently even Bald Guy Money, he's expecting silver to hit a minimum of like $230, and targets as high as $360 or $400 an ounce with this rebound in gold and silver. So yes, typically, interest rates in a normal market would hurt precious metals significantly, but not in a market like this, which now we're going to talk about the global financial crisis, or GFC 2.0, with the private equity failures that are coming, which are what's going to trigger the next financial collapse. I'm going to pull up an article that you recently wrote, Rob, on your Substack. Let me pull that up here quickly, and you can share with everybody what you have found.
So I just did some research because I was trying to figure out how bad is private equity, and social media had kind of been on it, but a lot of people are considered a bit more mainstream, or some people would say knowledgeable, in that this is their full-time job, and they may work for a big brokerage house as saying, we think it's contained, it's not a big deal. The Fed has said it's not, but Powell came out and said it's not a big deal. What we found there were a couple of studies we looked at. We looked at a University of Chicago Law School study, and we looked at a third-party nonprofit, which has been tracking specifically private equity failures since late 2023. And 3 out of 5 major bankruptcies have a private equity component. And there are 74. There's a table if you go to that first website, the PESP nonprofit project, where they have 74. Yeah, I think 74 records of failures between 2024 and 2025. This adds up to billions of dollars, and it adds up to tens upon tens of thousands of job losses. And these are major names that people would understand, in each industry. It's across the board. And not only is that becoming a ticking time bomb, there's 2 components. Adding into the fact that private equity is a part of most major corporate bankruptcies, at least a part, if not one of the main risks. The Chicago study went on to note that private equity bankrupts companies that it acquires. So between healthcare, or in any industry, healthcare, industrials, commercial, real estate, doesn't matter. When these private equity firms come in, they milk the company until it's dead. They leave it dying, and they put it in a vehicle in which they can't absorb the losses. And this is legal. It's a bunch of legal wrangling. So they take the money, bankrupt it, and then the business or the hospital or whatever it is goes out of business. And in the Chicago study, they did a lot of empirical data searching. It's a huge study. And what they found was that private equity will cause people to lose their jobs. They'll turn owned buildings in a business into rental buildings, drive up the rent to the point the business can't afford it, and basically stealing their asset for all intents. So they take all the money. And then the way that they've structured these entities is it socializes the losses to the community, because community either has to raise taxes or has to deal with these adverse effects in a lot of different ways. And so you got two components to private equity. Private equity bankrupts businesses overall. Not saying all private equity firms do this, but there are huge examples on a whole. And not only that, but after they take all the money out and these businesses go bankrupt, that leaves a debt bomb that now is socialized to the community and becomes a risk to the economy. And boy, if you're ever looking for a black swan, I've looked up and down over debt and repo market, all this stuff we've talked about that happened in 2008, and any possible way we could have another recession or a collapse of the economy. And private equity was not on my bingo card, but man, after I looked at those studies, I was like, wow, it's bad. It's really bad.
Well, the private equity, Gannon, I forget his first name. Gannon from he lives in Colombia. He does that venture capital or whatever
Yes.
conferences. He talks about it all the time. He's showing, the cockroaches, he calls them, how they're starting to scatter as they're starting to fail. Essentially, the private equity, what they were doing in 2008 with bad mortgages. They were putting bad mortgages with good mortgages, wrapping them up as AAA bonds or AAA mortgage-backed securities. They're doing it with private equity. They are putting good private equity loans with high credit score people with low interest rate, and then selling it to private investors as, hey, we're never going to lose money. Look at we're making 15-18% yields on this debt. And investors are like, oh, that's great. It's coming from BlackRock. It's coming from Blue Owl, whatever the large private equity firm is. Like, oh, they haven't lost money in 10, 15 years, whatever it is. They dump their money in there. It's the exact same thing. Those bad loans are now defaulting, and the whole thing is crumbling. And that's why they're refusing to allow people to withdraw their funds, because, if they pull the funds, the business is going to collapse. So they're capping it at 5% per quarter, and that's nothing when you compare how much equity or how much currency is put into these investments. So I think the first one was car loans that. George Gannon, right? That's his first name.
Gannon.
He pointed out in November, and he said, "Watch this. This is private equity. Their subprime car loans, they're failing." He's like, "This is the first domino." It was 100% right back in November.
10,000%. Yeah. Mm-hmm.
Yeah. And then now we're seeing them all tumble. The big ones, BlackRock, Blue Owl, all of them are starting to tumble. That's the trigger. That's going to be the catalyst to the financial crisis 2.0 versus mortgages, this private equity failures. And then how are the banks? There's an article, and I want to, it's an opinion piece. I'm going to share this, and I want to share my opinion on this article. It's called Private Credit Crisis or Growing Pains, Why the Big Six Banks are Safer Bet. I 100% disagree with this. George Gannon talks about this. He's like, what is happening is I'm BlackRock. I put together these investments with subprime loans, private loans with good loans. And then because, let's say, somebody with a 500 credit score can't get a loan from the bank, so they get it through Sophie or BlackRock or whatever. And then what they do is they give the loan to the individuals with the bad credit. Then they go to Wells Fargo. They go to Bank of America, like, hey, I'm BlackRock. Hey, I'm Sophie. I'm whatever. Let me get a loan to cover, what I just lent, a low interest loan. So they're charging the individual, let's say 15, 20, 30%. They borrow from Wells Fargo at, let's say, 5, 6, 7%. They're keeping the spread and giving the percentage to the investors. That's what's happening. So what happens when all those private equity loans default? Wells Fargo, Bank of America, Citigroup, JP Morgan Chase that were lending to these private equity firms are also going to collapse. This article, this Stephanie Link, I don't think she knows what she's talking about. I think this is just they're saying, hey, calm down. It's the exact same thing we saw in the first global financial crisis, where they're saying, no, mortgages are fine, Lehman Brothers are fine, everybody's okay. It wasn't. We're seeing the same thing repeating, guys. It's. What do you think, Rob? Do you think I'm on the right track here?
100%. And, I sometimes you do what I do and you get kind of ashamed that you don't see everything coming, but you just can't. I have to give myself grace and thank you to George Gammon and others that have been on this because they have a little bit of a bigger macro view than we tend to have on our channels. Credit to them for finding it, but it is such a freaking complex system. And that really, it all boils down to the system is so complex that I think that's where we're going to get the cascading failures. And the average person does not understand it. They do not understand that all leverage is leveraged on top of each other. If you look at foreign direct investment, not to bring up a new concept, but foreign direct investment is when one banking infrastructure of one country or a sovereign invests in another. Everything's connected this time, much more than it was in 2008, much more than it was during the Great Depression, much more than it was during the stock market crisis of the late 1800s, the economic crisis of the late 1800s. So if one goes down, they all go down. And the system is so complex that when you add in things like private equity defaults and problems with oil and problems with fertilizer, those are things that could tip it over. It's the domino theory. You hit the right domino, and if you're a kid and you used to dominoes and build, all those sets, and you hit the first domino and, it rolls out across your living room floor and 3,000 dominoes collapse and it generates a picture or whatever, that's cool. But that's also, that's the graphic I want people to have in their mind when they think about the systemic risk of the financial system. One domino, and there are so many. It's like that domino thing that you build in your living room, but you have 5 different places that you can knock over, and you don't know which one's going to kick off. Maybe you're blindfolded, and 4 of your friends, and you're sitting there, and then one person drew the stick to set it off. You don't know which one it's going to be, but it could be any of them. And once that domino goes, I don't care how much money you print, I don't care what the hell you do, you're not stopping it. You absolutely are not stopping it. And the people that hold precious metals, that is your refuge in the system, outside the system. I don't care what else you have, what asset you have. All other assets other than gold and silver are a derivative of the dollar at this point, from a pricing 100%. And a stability perspective. And if you don't have gold and silver, when that fuse gets lit, those cascading failures in this very complex system that no one has control over, including the Fed cannot stop it. Okay. The Chinese central bank cannot stop it. They're tools, but really they're using yield curve control to keep 10-year treasury from getting out of hand. The Fed is injecting massive amounts of money into the repo market. They're buying debt as soon as the treasury releases it. The treasury and Fed have both said that we're just buying our own debt because nobody in the rest of the world wants it anymore. I mean, it is a total and complete and utter mess. And we don't know when or where it's going to happen, but the risk is so high right now that I just, you look at this as, I don't see how anybody has confidence. So there's no social credit system. The FDIC is not going to save the banks. Their insurance fund is not even 1% of total deposits. Good luck. Once the bank in the bail-in laws and Dodd-Frank say that they can take your bank account anyway, it's law now.
Yeah.
So the only ways to get out of the system and have a certain component of savings in gold and silver to not only capture that inflation and help your purchasing power, but protect you when that system starts to crash and they start taking the money out of your bank account, which is law, and they take money out of your brokerage account from your stocks, which is law, and they hand you an IOU and say, we'll pay you later. Does you no good when you have to go buy groceries. And and Daniel, you've been investing for a long time. Is there anything else that you feel confident other than gold and silver, which is outside that system, which can handle that risk?
Absolutely not. In 2024, when the Fed cut rates in August, I sold all my stocks, sold all my crypto, sold all my investments, and put everything into gold and silver, 100%. Like I saw what the writing on the wall back in 2024, following Mike Maloney, George Gammon. I was watching everybody, doing my own analysis, and I knew once they cut rates, that was just the beginning, the first indication that we're going to have another global financial crisis. And I knew what happened in gold and silver, and then we entered the gold and silver bull market the next year. And I want to go back to what Osacker said. He asked a question, and in light of everything we've said so far, I get raising rates is what needs to happen to get us out of the national debt we're in. But raising rates also strengthen our dollar. Normally, yes, you raise interest rates to contract the monetary supply to strengthen the currency, but that doesn't always work. Before Milei got elected as president of Argentina, they had interest rates of like 150, 200% or something ridiculous, and they weren't being able to keep inflation under control.
Because they had reached the point of no return and it was a runaway. Sorry to interrupt you. Please keep going. Yeah. Once it runs away, I don't care what you do to interest rates, right? Keep going. Sorry.
Yeah, no, that's exactly what there's a point of no return when increase in interest rates no longer contract the currency, right? So that's what is eventually going to happen. We have too much debt. We're already at a point where our interest rates, the interest that we're paying is like, I think $2-3 trillion in interest owned. Our entire national budget per year is something like, I think it's 7 or 9 trillion. I forget what our entire budget is. I haven't looked at those numbers and you should know off the top of my head. But yeah, 100%. And now, OC Stacker, are both of you still buying precious metals, even though I understand you have a coin shops for yourselves? Yeah. I mean, my metals in the coin shop are a separate business where I have business partners. So I use my personal funds and I save in physical gold and silver or kinesis. A lot of my funds in kinesis and alpine gold, whatever. So I'll take my 10% and put them in precious metals. Or if I want to do something physical for a pay period or two, I just buy I buy the physical metal from my shop and I just put it in my personal savings. But yeah, I mean, I don't save dollars. I save in precious metals, whether it's physical or digital.
Yeah, and yeah, I'm going to use a really good financial principle. It's actually biblical, but this is taught in layman financial circles. It's 80-10-10. 10% goes to tithing, or if you don't tithe to a church or a temple or whatever, you can give to charity. You give to society. You give, to help out the community. 10% goes into savings, and you live within that 80%. And that over time has shown to, even when you hit hard times, to really sort of get you through those hard times, especially when you've been doing it for a long time. So the simple answer to the coming risk that we have is go 80-10-10. Like, you may want 100 ounces of silver. Maybe you can't afford it. But if you get your expenses to 80%, you give to the community or your church as an act of good faith, saying, I support my community and support those things that build the community, and then you save 10% on your own, that gives you the best chance to get where you need to be from a savings perspective. So just a quick little tip there. It's not complicated. And then if you're going to buy both gold and silver, I'm not going to make a recommendation. I'm going to say what I do. I do half and half, because gold, and it's simple, and not everybody does it, and people want to, play that ratio. The reason I keep it simple is because I never lose sleep, because my gold is going to be slow and steady wins the race. It's the tortoise. The silver is the one that jumps forward and gives you those big booms at times. And when you have both, then what you have is you have optionality in your savings to use one or the other when you need it. Because I'm telling you, there's going to be a time when people have been stacking for 30 years. And when this stuff starts going down, they're going to have to redeem it. And you need a little of both if you're going to do it. If precious metals is where, you want to be.
Yeah, my ratio is slightly different. I buy both, but I do 75% gold, 25% silver, just because gold is slow and steady. Like Rob said, it's more stable. Over a long period of time, gold has outperformed the S&P 500, the NASDAQ, the stock market, has stayed above inflation. Silver has kept up with inflation, but for a long period of time, it didn't. And now it has, right? It's definitely gotten above that point. But gold it fluctuates in a much tighter range than silver. Silver is a lot more volatile, as we've seen during this bull market. But guys, 10% minimum, right? You want to put 10% of your savings. Pay yourself first. I mean, that's what they teach you in high school. If they still teach economics or whatever, I forget what the class was in high school on how to do checks and everything. Pay yourself first. For me, that's gold and silver. Right, and you can do it electronically. You can do it through with Josh Anderson. We just interviewed him. You can do it through the Sound Money wallet. You can do it with Kinesis. You can do it through Alpine Gold Exchange. You can do it through a Glint. You can do it through One Gold. There's a lot of electronic versions. Or if you want to have physical, which I recommend, you should have at least 1 year worth of emergency fund. Half cash, half precious metals in that 75-25 ratio, or you do it, Rob, 50-50. You should have at least 1 year's worth of your monthly expenses at home. You can put it in a safe. You can hide it around in like $2,000, $5,000 bags or whatever your monthly expenses are, a month's worth of expenses in each bag, and hide it around your house. That's what some CIA agents, they hide them so it's difficult. If it's easy for you to get to, you didn't hide it well enough. It should be a pain for you to get to your money. Right, your gold and silver and your fiat currency. So you want it, if you're going to have a year's worth, don't put it all in one place, because somebody breaks in, they can break into your safe. They see your safe or have dummy safes. So there's different ways to do it. But if you don't want to go to that extreme, 1 year's worth of emergency fund where it's physical in cash and gold and silver, because when you have 50% cash, that's losing value, but the 50% gold and silver is maintaining. So you're always going to have that your annual expenses saved up in your house. Let's see. Here we go. What does he say? Oh no, we already went that. Let me see. What's going on here? Did I freeze? Did I get lost? Am I here? Okay, good. All right. Thank you, Rob. I do 60-30-10 as all debt is gone and I only have a monthly bills. Great advice. Absolutely.
Fantastic. If you've gotten to that point where you don't have the debt overhang and the monthly bills, man, you're in really good shape, honestly. So good job on that one.
Yep, absolutely. Well, I mean, I believe we'll see global financial crisis 2.0. Remember the inverted yield curve? Remember the difference between the 2-year and the 30-year, or was it the 10-year and the 30-year? I forget which one. It was the first time. It's a way to confirm we're in a recession. That was last year, I think, around August. The 2 and the 30.
2 and the 10. It's called a yield curve inversion, when the short end of the curve has a higher interest rate because there's more immediate risk in the system. Right. Whenever that stays inverted for any length of time, that is the most successful predictor of a recession in history. In fact, it's 100% predictor. 100%.
Yeah, 100%. We saw it in August. It kind of creeped back out in, I think, September. And if you look at it now, man, it's a massive inversion. I mean, it's like screaming. It's screaming we're in a recession, and we're starting to see the cracks. Unemployment numbers are skyrocketing. We're starting to see the private equities collapsing, which is going to reverberate to the banks. Banks are safe, guys. So just keep an eye out. And if you are not in precious metals, I mean, if you're watching this channel, you most likely are. But if you're just here learning about it, somebody shared this video with you, guys. Gold and silver is money. The dollar and everything else is credit, debt, or an investment. You're losing value if you're saving the dollar. So make sure you're protecting yourself. That's what we do at Citizens Sound Money. We promote the use of sound money, protect people's rights to do so, to use it. We educate people on sound money and financial principles through the Sound Money Movement Foundation that we have with the Sound Money Academy. And we're working with the industry to create industry standards and to promote sound money through legislation, regulations, and through the industry itself. OC Stacker, I'm a prepper stacker, so on board with what you guys are dropping. Thank you. Thank you, OC Stacker. Any other thoughts, Rob, about the potential global financial crisis 2.0?
Yeah, I think we're a lot closer to, because I've been saying that forever. People say you're the boy that's cried wolf, right? I said, I want to say 2018 or 2019. I'd been writing for 10 or 12 years at that point. I can't remember. And I said, I think it's going to happen in the middle of this decade. And I was a little quick on it because we're in 2026. We're still kind of technically in the middle, but I think we're so very close to it. And one of the ways you can tell, and this is a horrible indicator, but I found it to be true, is that all of your government leaders and financial pundits will scream that everything is fine right before the collapse comes. And Powell did a big interview where he said, I don't see an issue with private equity. I don't see an issue with Iran war and oil. I don't see an issue with interest rates. I don't see an issue with employment. And there will be no consequences of the U.S. printing the most debt in history, even though we know from Yale and Harvard research professors Reinhardt and Rogoff, after 2008, went back in history of every major economy and said, when do we get to the point in which we're going to have a debt failure and a currency failure? And it was 90% debt to GDP. We're way over 90. We're in the hundreds. It was 140 and it's 120. No nation in history since we've had financial records has ever survived that, and we're way above it. And for Powell to say that looking at history and looking at America, we can basically have as much debt as we want, print as much currency as we want, is ignorant of history. And I don't think he's stupid. I think he's smart, and I think he's lying. And I ran a poll on Twitter. Do you think Powell's lying? And overwhelmingly the response, I got hundreds of votes, said Powell's lying. And when your leaders are lying to you like that, the way that they're lying, because usually you can get them to admit some things are not great. It's like a whitewashing right now across mainstream financial media. Everything's great. Don't worry. This is what happened in 2006 and 2007 before the mortgage crash. And then it was Lehman and it was a mess. And the only reason I knew that ahead of time is because I was working at Ernst & Young and we were on an engagement for a division of Morgan Stanley that bought 52,000 adjustable rate mortgages, basically trash or junk loans. They were so screwed up that I knew before Lehman that if all mortgages were like this, we were in serious trouble. And the mortgage market got leveraged 5x to what it should have been. And the collapse was just nasty. And that's when the Fed had to print money just to save the entire world economy. It's that domino effect I said before. In 2008, the Fed and these other countries that started printing currency, because China did it, everybody did it. They saved it, but studies show you can only do that one time. You can't do that again. As soon as they start printing currency like that again in a crisis is when you have the run. And that's what people need to pay attention to. And when everybody's lying to you and playing the same script, there's one more thing I want to say. There is a video out on Twitter showing a bunch of local media saying the exact same phrase on the economy. The exact, there's no way this can be done unless they were told to say it. It's the same words, and the video has like 40 different local news outlets saying the same thing. When you see that, and you see the Fed lying, and you see the government lying and doing desperate things like attacking Iran with not a great plan, because now we're backing out on whatever the plan was, and it's plan 2.0 or 3.0. Those are signs of desperation. And I'm not making a political judgment. I'm making a financial analysis. When you see these things, when you see desperate governments and you see massive lying and you see coordinated reports like we're seeing, this is what happened in 2007 and 2008 before the Lehman crash. And we're here again. And we've also seen the repo market, the overnight lending market. Everything is on fire now. Everything. It's like all the things that have ever led to recessions are busting at the same time. And it's not just the US, it's across the world.
And the interest rates, if you take what they've done with interest rates and superimpose it in 2008 with the interest rates, 2007, it's almost identical. If you look at what the stock market did, the moves the stock market did back in 2008 and today, right before the bust, it's almost identical. If you look at the yield curves, I mean, history doesn't repeat, but it sure as hell rhymes. And it is rhyming, it is lining up. And I mean, guys, it is the Mike Maloney has been yelling the red flag since I started watching him in 2023. I started following, doing my own analysis, and I said that there's going to be a major debt crisis in November of 2023. My trigger to sell everything was when they cut rates in August of 2024, and then
Yeah.
it's just been slowly everything falling into place. Getting out of stocks, getting out of the equities, getting out of all my investments. Crypto was the best financial decision I made because I was watching, I was listening for the storm, waiting for it to come, and it's finally coming. It's finally coming to fruition. And the great financial crisis of 2026, I think this is the year. I thought it was going to start last year, back in 2024. I mean, it's been delayed, and they have they delay it as much as they can by printing currency. They have a lot of ways, the institutions, the banks, of delaying collapses. But guys, it's slowly happening for sure.
It's
So if you're
tipping over.
watching,
The economy,
tipping
the
over.
debt-based economy is tipping over, and it's in every single statistic that all of the eggheads at the big financial schools are going to teach you simultaneously.
Yeah.
The potential for this is really a cascading default, and it depends on the health of each country's central bank and how much gold and silver they own. It depends upon resource. Why you're seeing commodity wars right now is if you don't have commodities and what's coming, you're screwed. And the U.S. has outsourced so much of its commodity infrastructure that now it's having to take it back, and it's panicking because unlike the Great Depression, which my parents lived through, most of us aren't on farms and we don't have manufacturing, including commodity manufacturing. And I think the Trump administration sees it, and they are literally doing crazy stuff to boost up it. He wants to boost up real estate. He wants to boost up manufacturing. He's trying to do all the right things. Now, you may quibble with the way he's doing it, but he sees the writing on the wall. I'm telling you, they know. Yeah. I can see it in their faces, and they're doing desperate things because on the flip side of when this goes, if you don't have your resources, you're in serious trouble from being able to get out of it and recover. And the worse position you're in there is the longer that recovery takes. So if you're watching this video, make sure that you have enough savings to last for an extended recession, at the very least, an extended recession that will go longer than the great financial crisis.
Yeah, I say a minimum of 6 months. I know not everybody can do that. So if you can't do 6 months, 3 months, bare minimum, you need an emergency fund. But if you can do 12 months to withstand this financial crisis, or even I got some customers that have 2-3 years worth of a emergency fund in precious metals and cash, do that as well, because we don't long this global financial crisis. It lasted 2.5 years, and it really lasted a little longer, the after effects. But guys, it's we're basically screaming from the YouTube the hilltops that it's coming. All the income, we've been talking about it for 2 years. When we had the Rob and Dan show on X, we were talking about it. But 2.5 years ago, then a year, we've been talking about this for a while. It's finally coming, guys. And just we don't want this to hurt people. We want you to be prepared. We want you to save. Make sure you have your financial household under control and protected. And the only way to protect your finances is to be in gold and silver, to protect against the financial the inflation that's going to be coming during this next global financial crisis, and having some cash sets. We live in a cash world. You need cash, but if you have that 50-50 split, half of it's losing value, the other half is protecting it, so you're going to have that same purchasing power over time. So I think this is going to be go ahead.
One more point I wanted to make. I was just having a conversation with somebody that's we're involved with in our organization on gold legal tender bills, and we're watching the bills across the 50 states to see where it's going to be made legal tender. Are these good bills, or should we oppose them or modify them? And through part of that, there is a trend amongst state lawmakers to put some sort of legislation in there that requires cash to be in society, dollars. And you may think, why, if the dollar is going to come under pressure? Because if we go purely cashless, a lot of people are going to be in serious trouble, because not everybody's prepared with assets outside of the traditional financial scheme. And we still need cash to stave off like an all digital type of system. And so there is a lot of impetus, not only amongst the gold silver movement, but amongst tons of financial professionals. Dave Ramsey, for example, in passing bills to ensure that we do not go cashless. Catherine Austin Fitts, Dave Ramsey, a lot of these big financial people, powerhouses, are saying, have a bucket of cash and don't let them go cashless. Because once you go digital, and you've got Dodd-Frank and all these other laws since the late 90s, which basically says they can take all your money legally out of your account, you're going to need a bucket of cash, enough to get you through the immediate crash. And then you need the longer term assets like gold, silver, or other things that you think are going to have value. Again, not a financial recommendation. I'm just telling you what all the financial pundits are saying. And I'm telling you the scuttlebutt around state legal House and Senate circles is cash, cash, cash. The federal government wants to get rid of cash. The states want cash because they know what happens if we don't have it.
And let's say you're a skeptic and you're like, you guys are crazy. There's not going to be such a global collapse that we need to have all this cash. All right, let's give it to you. Let's say there isn't going to be some type of Great Depression where everything happens and we're going to need cash to survive in the short term. Disasters, natural disasters occur. Look what happened in Asheville last year, where, I mean, the half of the area from Asheville north and south, I mean, it got impacted as far south as Georgia. We're out of electricity, out of a cell phone. They didn't have any power, water, and nothing. If you had crypto, if you had debit cards, you could not pay for anything because Hurricane Helene knocked everything out, killed thousands of people with landslides. There was no infrastructure for months in Asheville. They're still kind of recovering in that area. So just for prudence sake, preppers, they get a bad rap. But like Florida, we all prep in Florida because we get hurricanes every year. You don't call us crazy because we're prepping for natural disasters. So just prep for the worst case scenario where a natural disaster takes everything out. And then you have your food, you got your solar panels, as OC Stacker was saying. He's recommending 1 year of cash, 10 years of precious metals, 1 year of food storage, solar panels, and a generator ready as I can. I have all that. I have the food, I got the solar, I got the generators, I got the metals, I got the cash. I mean, you want to prepare for, and that's just because of hurricanes, right? I've been a prepper without knowing I was a prepper because I'm prepping to protect myself from a hurricane, which can knock things out for weeks,
you're
even
in Florida,
months.
and hurricanes get pretty nasty over there.
Yeah. So now, as a silver stacker, I'm like, let me just extend this a little bit more. Let me buy a few thousand rounds of ammo. So I kind of compiled it on there. But guys, it's just prudent and practical steps to protect yourself from natural disasters, or in this case, a major global financial crisis. Mike Maloney's been saying that that this could be worse than the Great Depression, and the way things are looking, I think it's completely possible.
Yeah, one little personal anecdote I want to throw in there. Nobody's ever heard this before publicly. A few years ago, I lost my job because I refused to take the COVID vaccine. I was working from home in cyber. There was no risk whatsoever to me not taking it, and they tried to shove it down my throat. And I told my company, "You're violating my constitutional rights." And I said, "I don't, maybe I'll take it, maybe I won't, but that's my right, not yours." And they said, "You can no longer work here." And and because I said constitutional right, what they basically did was gave me a big severance package to get me to shut up and move on. And I'm like, fine, no problem. But I lost my job and a lot of my business collapsed as well. And what I lived on was the bucket of cash I had saved and the gold and silver. And thank God that I had. And that got me through. And thankfully, I've been blessed by God with a good job, a good business, and association with good people, that I was able to recover that and kind of rebuild. And that happens to everybody. It happens to people like me who've been studying the economy for almost 20 years. If I hadn't made those preparations, I might have been living out of my car, because I made preparations, and that job loss and the things that happened, I was able to survive during that, recover, rebuild. I switched careers, got a great new job with a company I love, rebuilding business, and I made it through. So that is a personal lesson to all you guys out there that may be watching this video. You never know how it's going to happen, when it's going to happen, or what it's going to look like. But having a general level of preparedness financially is always a good idea. And at the end of your life, if you have more money and know what to do with, you can will it to your kids, you can donate to charity, you can put it to good use. So it's never bad to have a little stack of cash because you can help other people if you don't need it.
Yeah. No, 100%. And we don't have time. We got to wrap up this show. But trusts, living revocable trusts, whether you have one or not, I think everybody, whether you have 2 shekels to your name or $10 billion, should have a living revocable trust. We're going to have that on our Sound Money Academy. I own nothing, but I control everything. Literally, the clothes on my back are in my trust. I literally don't own anything, guys. Control it all because I'm the trustee grantor, and my trust appoints me as the manager of different companies. And that's how you protect yourself and you avoid probate. So there's no questions on who owns what. They have the United States trusts have never lost in court. They have 100% record of winning based on how you want to put out your assets, the beneficiaries, and so forth. So that's a completely different topic. But yes, 100%. You should protect yourself by buying precious metals, having cash, lead, solar panels, all that. But you also want to plan as well. I used to be a life insurance agent, and the biggest thing that broke my heart was when there was no plan in place other than the life insurance policy, and the widow or the widower had no idea where the funds were and nothing. So we're going to have that type of education in our Sound Money Academy at soundmoneymove.org. We're coming out with modules. We're about to launch our first module course on financial literacy, sound money principles. We're going to have Lynette Zhang do a course. We're going to have Dr. Eric Snyder. He's an Austrian economist doing a course. We're going to have Morgan doing a course, and we'll start providing this education for free. Some of them will be premier education where you can get certificates as well. So just stay tuned. If you're not following us, go ahead and give us a follow on X, and go ahead and check us out at citizensforsoundmoney.org, citizensforsoundmoney.org, and soundmoneymovement.org. Any last words, Rob, before we end the broadcast?
Yeah, one thing on trust, just to expand on that. Great idea. The trusts were created by their elites to protect their assets from raiders and also during difficult times. And you're right, 100% protection on trust. It's supported by the Constitution, the law of private contracts. Courts can't break it. If they do, they've gone rogue, and we've never seen that in American history. Trusts are a very good idea. Last thing I wanted to say is OC Stacker's been pumping out the comments on the channel. We haven't gotten to all of them, but I agree with everything that you said, OC. Good job on all that. And if you're reading OC's Stacker's comments, these are all really good suggestions.
Absolutely. All right, guys. Well, thank you so much for watching. I think this is actually the most live viewers we've ever had. 316 concurrent viewers across all the platforms. So this video is probably going to go viral. I think the last time we were on a video with that many concurrent viewers, it was like in the 200s. So thank you for watching. Go ahead and give us a follow. Go ahead and share this video and give us a like. If you like this video with all the information we've shared about the global financial crisis and the advice of how to save and how to protect yourselves, we'll get to more people. That's what the algorithms on YouTube do. So go ahead, give us a like. We'll be back next week at 7 p.m. Eastern. No, 6 p.m. Eastern is our live broadcast. Our premieres are on Friday at 7 p.m. We interviewed Carolyn from the Washington State Coin and Bullion Association. They're fighting the same thing we're helping to defeat, which was the elimination of the sales tax. It's killing the industry in Washington. Don't miss that premiere. You're going to love what we discussed. And there's a little cut in there where we actually bring in some legal advice on whether or not it is constitutional or legal to have sales tax on U.S. legal tender coinage. Watch that this Friday at 7 p.m. Eastern Standard Time. Thank you, guys. God bless you all, and we'll catch you on Good Friday this Friday.